The Federal Reserve just made a pivotal decision, and, well, its echoes are reverberating from Wall Street right down to your wallet. After 5 consecutive holds, the Fed chose to maintain interest rates, and it's sparking some intense debate. Is this a wise pause or maybe a missed opportunity to rein in what feels like persistent inflation?
Right. That's the core question everyone's asking.
And we're hearing loud calls, from Capitol Hill for the Fed to reconsider its path, questioning its very independence and responsiveness to the real economy.
Yeah, the pressure is definitely mounting.
Meanwhile, the signals are just, well, mixed. Are we truly seeing price stability, or are certain policies maybe still fueling an inflationary fire? And the job market, is it really as strong as it looks, or are some key sectors starting to slow down?
It's a very confusing picture.
So you might be wondering, what does this highly technical decision actually mean for your cost of living, for your savings, and the future of your financial security?
Yeah.
In this deep dive, we're going to unpack the Fed's latest move, explore the powerful pressures on the central bank, dissect the conflicting economic data, and look at 2 competing theories for what's really driving prices, and importantly, what that means for you. All right, let's unpack the big news first. The Federal Open Market Committee, the FOMC, they met on July 30th, 2025, and made the call to keep the federal funds rate right where it is. That's between 4.14 and 4.12%.
Correct.
And this is, the 5th straight time they've hit the pause button?
Yeah.
So what's really behind this decision to just hold steady?
Well, the Fed always comes back to its core mission, what they call the dual mandate, trying to get maximum employment while also working to bring inflation back down to that 2% target.
Right.
And this time, the committee was pretty explicit, saying they faced elevated uncertainty about the economic outlook. That uncertainty clearly played a big role in their decision to hold rates.
Okay.
But, and this is really crucial to understand, even without raising rates, the Fed is still, sort of quietly but powerfully, tightening the money supply. They do this through something called quantitative tightening, or QT.
Right.
Think of it like this. The Fed built up this huge pile of assets, government bonds, mortgage-backed securities, basically packages of home loans during past crises to pump money in. QT is the reverse. They're letting these assets mature and just roll off their books without buying new ones. Right now, the caps are $60 billion a month for treasuries and $35 billion for those mortgage-backed securities.
So money is leaving the system.
Exactly. They're slowly shrinking their balance sheet, pulling liquidity out, making money just a bit harder to come by, even when that main interest rate, the headline rate, stays put. It's a subtle but pretty significant form of continued tightening.
That's a great point about the quiet tightening happening in the background. But here's where the plot really thickens, I think. This decision wasn't unanimous.
No, it wasn't.
In fact, it seemed to ignite a rare internal firestorm, leading to a double dissent. And that's the first time we've seen 2 members vote against the majority since, 1993?
That's right, 1993. It's highly unusual, and it definitely signals some deep divisions inside the Fed.
So who were these dissenting voices, and why does their disagreement matter so much right now?
Yeah, the 2 members who voted against the hold were Michelle W. Bowman and Christopher J. Waller. Both were appointees from the previous administration.
Okay.
And they both actually wanted a 0.25 percentage point rate cut. Their main arguments were essentially skepticism, that the recent tariffs would really lead to persistent, widespread inflation and also a growing concern about what they see as a deteriorating labor market.
So they're worried about jobs more than inflation from tariffs.
That seems to be the core of their dissent, yes. And this internal split, it isn't happening in a vacuum, right? It's set against this very public, very intense backdrop of external political pressure. Former President Trump has been really vocal, consistently pushing for rate cuts. He's even publicly threatened to replace Chair Jerome Powell in the past. And just last week, apparently he made a visibly tense visit to the Fed's headquarters, driving home his demands for lower rates.
Wow, a tense visit.
Yeah. And then you also have the Treasury Secretary, Scott Bessent, publicly calling for a comprehensive review of the Fed's performance. That adds another layer of political scrutiny.
So pressure from multiple angles.
Absolutely. It got so intense that we even saw an investment firm file a lawsuit, though it was quickly dismissed, but it actually accused the Fed of making politically motivated rate decisions, which is just an extraordinary claim, but it really underscores the charged environment they're operating in.
That's incredible.
And what's truly fascinating here, and maybe a bit unsettling, is that history gives us some pretty stark warnings about this kind of thing.
Like what?
Well, when the Fed seems to bow to political pressure, markets often end up paying a heavy price. Think about the Nixon-Burns episode back in 1971.
Yeah.
President Nixon openly pressured the Fed chair at the time, Arthur Burns, to cut rates before an election. Burns eventually, conceded, and what happened? A painful 5% inflation spike over the next 4 years, soaring bond yields, stocks cratered. It was a period of significant market instability.
Not a good outcome.
Not at all. And even more recently, remember during the Trump administration's sort of open criticism of the Fed's credibility in 2018-2019, we saw significant market volatility then too. The S&P 500 dropped 20% before it eventually rebounded.
Right, I remember that volatility.
The lesson seems pretty clear. Political interference doesn't just, twist economic policy. It erodes the very trust that markets need to function. Markets thrive on predictability and independence from short-term political whims.
That's a really powerful reminder of the delicate balance the Fed is trying to maintain.
So, okay, given this intense pressure, the internal disagreements, what's the actual economic reality they're grappling with right now? They have that dual mandate, jobs and prices, but the data seems to be sending just incredibly confusing signals. Let's try and break down the latest numbers you've been looking at.
Absolutely. The economic picture is definitely a mixed bag, almost like a puzzle where the pieces don't quite fit together neatly. Let's start with inflation.
Okay.
The Consumer Price Index, CPI, that tracks the cost of a typical basket of goods and services. It rose 2.7% year over year in June. That's actually an uptick from 2.4% in May.
So going the wrong way slightly.
Slightly, yes. And if you strip out the more volatile food and energy prices, you get core inflation, which stood at 2.9%. Both numbers are still above the Fed's 2% target.
Still sticky then.
Exactly. And tariffs seem to be playing a noticeable role here, contributing to surging prices, especially for things like home furnishings and clothing.
Okay, so inflation's still hot. What about the job side? All right, the labor market. On the surface, the unemployment rate is holding steady at a relatively low 4.1%. That looks strong.
Mm-hmm.
And non-farm payrolls, the main measure of jobs created outside farming, did increase by 147,000 in June. But, and here's the subtle, maybe concerning detail, private sector hiring actually contracted. It fell by 33,000 jobs in June.
Contracted. So negative private job growth.
Yes, the first decline in private sector jobs in over 2 years. So that suggests that beneath those headline numbers, job growth might be nearing, let's say, stall speed in some really crucial areas of the economy.
Okay, that's definitely a crack appearing. What about overall growth, GDP?
Yeah, looking at the broader economy, real GDP, that's total output adjusted for inflation, actually shrunk at a meta 0.3% annual rate in the first quarter of 2025.
It shrunk. Wow.
Now, forecasts expect higher growth in Q2, possibly pushing total output above $30 trillion for the first time, not adjusting for inflation. But it's really important to understand why that Q2 growth might look better.
Okay, what's the catch?
It's largely thought to be due to a historic rush to front-run Trump's tariffs back in Q1. Basically, companies bought a lot of goods early to avoid higher costs later.
So borrowing growth from the future, essentially.
Kind of, yeah.
Yeah.
So that Q2 number might be more of a distortion than a sign of really robust underlying strength. There are growing concerns that this combination of tariff-induced cost pressures, the persistent policy uncertainty, severely curtailed immigration affecting labor supply, and, of course, the elevated interest rates, that all these things together are dampening employment, business investment, and household spending.
So we've got this stubborn inflation, jobs showing subtle cracks, the overall economy grappling with these tariff distortions, and maybe underlying weakness, especially in areas like housing. You mentioned rates are high there.
That's right. The housing and construction sectors are clearly struggling. 30-year fixed-rate mortgages are hovering near 7%, and construction spending has actually fallen for 9 straight months. So that's a clear drag.
It really paints a complex, almost contradictory picture for the Fed, doesn't it?
Absolutely.
And all these conflicting signals, they bring us back to maybe the biggest puzzle piece of all. If inflation is still above target with some sectors surging, what's truly at the root of it? Is it simply too much demand with, consumers and government spending too much? Or is it something else entirely, something more structural that maybe the Fed's current tools just aren't equipped to fix?
That is the absolutely critical question, and it's really where the economic debate is raging right now. The conventional wisdom, the view you hear most often, points to excess aggregate demand. Basically, too much money chasing too few goods, often linked back to all that government spending during the pandemic.
Right, the stimulus checks argument.
Exactly. However, there's a powerful and, I think, increasingly influential alternative perspective. It's been particularly well articulated by the Roosevelt Institute. They argue that today's inflation is largely driven by supply shocks and sectoral demand shifts, not by excess aggregate demand.
Okay, so a supply-side explanation. What's driving that, according to them?
They pinpoint several key factors. First, the obvious disruptions from pandemic shutdowns and reopenings that just gummed up global supply chains.
Sure.
Then, the impact of Russia's invasion of Ukraine, especially on global food and energy prices. Persistent issues like the shortage of microchips for automobiles is another.
All right, the chip shortage.
But they also introduce more structural element, an increase in market concentration, which has generated greater market power. In other words, fewer big companies dominating industries means they can raise prices more easily without worrying so much about competition.
Interesting. So less competition equals higher prices. What's their evidence against the idea that it's just too much demand?
Well, they make a few key points. They note that real personal consumption and total real aggregate demand have actually, for the most part, been below their pre-pandemic trends. That makes it kind of hard to argue there's simply too much money sloshing around overall.
Below trend. Okay.
They also point out that U.S. inflation, while high, is no worse than in other developed countries, even though the U.S. had a more robust economic recovery and more fiscal support. This suggests causes beyond just U.S.-specific demand.
That's a fair point. What about wages? Isn't there a concern about a wage price spiral?
That comes up a lot, the fear of rising wages chasing rising prices, creating a vicious cycle. But the Roosevelt Institute suggests it's unlikely right now. They explain that nominal wages already tempered, meaning wage growth has slowed down. And critically, declining real wages are typically not a sign of a tight labor market.
Declining real wages meaning pay isn't keeping up with inflation?
Exactly. If workers' purchasing power is actually falling, it's hard to argue that their wage demands are the primary driver of the inflation we're seeing.
That's a fascinating and pretty provocative theory that really shifts the focus away from just demand. But realistically, how much traction does this supply-side idea have among other leading economists? What are the main critiques from those who still firmly believe it's primarily a demand-side problem? It's important to hear both sides, right?
That's a very fair challenge, and you're right. While the supply-side perspective has definitely gained ground, especially after the unique shocks of the past few years, many mainstream economists still emphasize the role of aggregate demand. They might acknowledge the supply constraints, but argue the sheer volume of fiscal stimulus during the pandemic simply poured fuel on the fire, exacerbating the problem.
So they'd say demand was excessive, even with supply issues?
Pretty much, yes.
Yeah.
They might also point to the initial surge in consumer spending on goods, for example, as evidence of overheating demand. The debate also gets into the weeds on things like the Phillips curve, that traditional idea that low unemployment leads to higher inflation.
Right.
The Roosevelt Institute argues that link has been weak and unstable recently, meaning trying to cool inflation by deliberately slowing the job market might just cause unnecessary pain without solving the root supply problems. But traditionalists would argue the curve, while maybe shifted or changed, is still relevant.
So different interpretations of the same data, essentially.
To a large extent, yes. And the implication, if inflation is primarily supply-driven, is pretty significant for the Fed. It suggests that monetary policy raising or lowering interest rates is a blunt instrument, as the Roosevelt Institute puts it.
Blunt how?
Well, they warn that using rate hikes to fight supply-driven inflation will greatly reduce inflation only at the cost of unnecessarily high unemployment. It could even backfire by impeding investments that might alleviate some of the supply shortages. Think investment in green energy or chip factories. Or, paradoxically, it could even be inflationary in some areas, like pushing up mortgage rates, which can feed into higher rental costs.
So potentially causing a recession without fixing the underlying problem and maybe even making some things worse.
That's the core concern from that perspective, yes.
Okay. So we have a central bank grappling with these conflicting economic signals under immense political pressure and operating within this really deeply contested understanding of what's truly driving inflation. Given these incredibly complex forces at play, what are the real implications for policy? And maybe most importantly for you, our listener, just trying to navigate your own financial world.
Well, if you lean towards the premise that inflation is largely a supply-side issue, the policy implications are pretty significant. The Roosevelt Institute, for instance, really champions well-designed fiscal and other policies, things beyond the Fed, that can help to ameliorate the supply shortages, tame inflation, and protect the vulnerable.
What does that look like in practice? Not just Fed action.
Right. It means government policies aimed directly at the bottlenecks. Things like investing in renewable energy to reduce reliance on volatile fossil fuels, maybe curtailing market power through stronger antitrust enforcement, boosting domestic production of critical goods like those microchips we talked about, and maybe increasing labor supply through policies like better childcare or immigration reform. These are more structural changes, not just tweaking interest rates.
So using different tools entirely.
Exactly. And from this perspective, the call is for a measured monetary response from the Fed, meaning they should be cautious about overly aggressive rate hikes that could cause undue harm. They even float the idea that the traditional 2% inflation target, which, as they note, was kind of pulled out of thin air decades ago, might need to be at least temporarily revised if sticking rigidly to it forces the Fed to inflict unnecessary economic pain.
Revising the target, that would be a huge shift.
It would be. Now, for you as an investor navigating this, some sources offer some practical thoughts, given these dynamics. Diversifying across asset classes is always sort of standard advice, but maybe specifically favoring inflation-protected securities like TPS Treasury, inflation-protected securities, and shorter duration bonds could offer some stability.
Okay.
In the stock market, you might consider leaning into inflation-resistant sectors like energy and materials, while perhaps being more cautious with sectors that are really sensitive to interest rates, like utilities or real estate. Geographic diversification is another idea, looking at markets maybe less prone to the kind of political manipulation we've discussed, and just maintaining a solid cash reserve. That gives you flexibility to perhaps capitalize on volatility if political pressures trigger market dislocations.
So be diversified, maybe tilt toward inflation protection, and keep some powder dry.
That seems to be the gist of the advice, yes. But the overarching cautionary note, really, is that excessive tightening of monetary policy can and likely will induce a recession.
And recessions hurt people.
Deeply. And we know from history, they disproportionately harm vulnerable groups. For example, black unemployment is often nearly double that of white unemployment during downturns. It really underscores the severe human cost of using these blunt monetary tools if they're misapplied to the wrong problem.
So as we bring this deep dive to a close then, it's just incredibly clear the Federal Reserve is navigating this unbelievably complex landscape. They seem caught between, the lessons of history, an unprecedented surge in political crosscurrents, and all while grappling with these immediate economic realities that just seem to defy easy explanations. It really feels like they're trying to thread a needle with, a thread made of spaghetti, balancing so many conflicting forces.
Yeah, that's a good way to put it. And if we connect this to the bigger picture, I think the debate around today's inflation isn't just about abstract economic models. It's really about fundamental choices and, frankly, where we place our trust. Well, are we truly trying to address the root causes of our economic challenges with targeted, maybe structural solutions? Or are we risking further instability by relying mainly on what some are calling these blunt instruments like interest rates that might end up inflicting more pain than they actually provide solutions? At least this was something pretty profound to consider, I think.
Which is?
In a world that's creating predictability and stability, how much can we really afford to compromise the independence of the very institutions designed to provide it? And what happens when the very definition of something like inflation becomes in itself a political battleground?